Hey, TMFG community, Carlo Cancino here with John Iaconetti. And today we'll be looking at whether 1.7 million at age 57 can realistically support retirement in Canada while spending $9,000 monthly.
With years of experience helping Canadian clients evaluate early retirement, we built a framework that account for CPP timing, old age security implications, and Canadian tax rules when determining sustainable withdrawal rates.
And that's exactly why we're making this video, to test whether 1.7 million is enough for Canadian retirement with $9,000 monthly spending and what factors will determine success.
Most people rely on calculators or maybe just the 4% rule, but those break down when applied to early retirement, high spending, and Canada's tax system.
So today, we'll be stress testing 1.7 million against real Canadian retirement variables, withdrawal sequencing, CPP and OAS timing, RIF rules, healthcare before 65, and inflation.
This isn't about feelings or optimism. It's about math, policy, and Canadian-specific planning.
So let's ask the question. At 57, with 1.7 million saved and a $9,000 monthly spend, can you retire today?
So here's the technical challenge. The 4% rule says 1.7 million supports about $68,000 per year.
But simple arithmetic, $9,000 a month equals $108,000 annually. That's already approximately $40,000 above the threshold.
And in Canada, it's not just about the math. You have to factor in taxes, healthcare before the age of 65, and government benefits like CPP and old age security.
And that's what we find that is the problem with the rules of thumb. They ignore sequence risk, market volatility, and inflation.
So I guess the gap is clear. You're trying to withdraw $108,000 when the safe range might be $60,000 to $70,000. Without adjustments, that's just not sustainable.
And that brings us to the main question. Can strategy, not just savings, close that gap? So before we answer, we need to test the plan against 6 key factors.
Each could shift the outcome from a yes to a no.
Withdrawal rates, tax sequencing, CPP and old age security timing, healthcare costs before 65, RIF minimums at 71, and inflation stress tests.
Ignore even one, and the plan may fail in real life. So let's get started with the withdrawal rates. $108,000 from 1.7 million equals about 6.3% withdrawal rate. So that's well above the 4% guideline.
And in Canada, safe rates are often closer to 3.5%. So that makes 6.3% a red flag unless you are considering other income sources. Now, let's talk about account sequencing. Withdrawals from RRSPs, TFSAs, and non-registered accounts are taxed differently.
Exactly. I mean, you pull too much from RSPs early and you inflate taxes. Delay too long and RIF minimums later can force you into higher tax brackets.
So if you do sequence correctly, it could save you thousands of dollars per year. Let's talk about the timing of CPP and old age security. CPP can start as early as age 60, OAS at 65. Both benefits will increase if you delay them.
Delaying boosts CPP by about 8.4% annually past the age of 65. That creates higher guaranteed income later and easing the portfolio strain.
What about healthcare before 65? Retirees may face $400 to $800 per month in private healthcare costs.
And that could bump your spending above $9,000 until public coverage is going to come in and fill the gap.
RIF minimums at age 71. People know that at 71, RSPs have to convert to RIFs, with minimum withdrawals starting at 5.28% of your portfolio value.
By your late 70s, withdrawals can exceed 8%, often pushing retirees into higher tax brackets and triggering old age security clawbacks.
Lastly, inflation and market volatility. With inflation recently hitting 6%, even at 3%, $9,000 today becomes $12,000 in 15 years.
Now, combine that with potentially a bear market early in retirement, and sequence of return risk can erode savings pretty quickly.
So again, is $1.7 million enough? Not without a plan.
The solution isn't saving more, it's structuring withdrawals, timing CPP and OAS, and managing taxes so that 1.7 million stretches a little bit further.
So here's how to approach it. Number 1, you run cash flow projections with inflation. Number 2, you test different withdrawal sequences. Number 3, model early versus delayed CPP and OAS benefits. Number 4, include taxes and OAS clawbacks. Number 5, account for healthcare until 65. And number 6, stress test against negative markets.
This eliminates guesswork and shows exactly how long 1.7 million lasts under Canadian conditions.
Sometimes it's not about cutting lifestyle. It could be delaying CPP, shifting withdrawals, or part-time work for a few years.
The right framework turns "do I have enough" into a confident yes or no answer.
Right. If you're over 50 in Canada, your retirement success depends less on your savings number and more on how you structure withdrawals, time CPP OAS, and plan for taxes and healthcare.
And that's why we created a free training that dives deeper into these Canadian frameworks.
Click the link below to watch it and learn how to stress test your own retirement plan.
Because the difference between retiring confidently at 57 with 1.7 million and running out of money isn't just luck, it's going to be strategy.